Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, May 16th, and then see how things look for Wednesday, May 17th. We still continue to be in a range. We're still pretty much mixed overall, where after yesterday, we kind of went to the upper side of this range that we've been in. Well, in Tuesday's action, we ended up coming down, not really to the lower side. We could still go lower than that, but we're just jockeying around, going up and down, as the market still tries to figure out what to do. One question we want to ask is, can the market put in a low by consolidating sideways? That has happened before. We don't really know if that's happening, but if we look for some kind of a breakout and a lot of our indexes start to show a lot of improvement, that could be what's happening here. Or it's just that the market is so indecisive, waiting to put together all the information that's coming together before it gets ready to head lower, because we're still showing a lot of negative divergences. That could also be justified at this point as well. So we just take it day by day, evaluate things, and then come to the best conclusion that we can based on the evidence that we have in hand, and then just go forward from there. Before I get started, I do have a supplemental video that I updated a little over a week ago. Those charts have not changed very much. I look at them every day, so that video is still very relevant to what's happening right now. I do have a PDF that you can get in the description for the podcast, the YouTube video, as well as the Rumble video. I have a private Facebook group that you're welcome to join. And there's no poll posted for this week. I've just been too busy trying to catch up on all the other videos. I know it doesn't take all that long to put up a poll, but I've just been distracted going in different directions. Let's go back and talk about what happened. We did have a lower open, and prices fell below the daily pivot at 41.29. We went down to S1 at 41.17. As the day went on, we chopped between S1 to the downside and the daily pivot to the upside. And then we saw some late day selling, which took prices down to the low right at the close. My understanding is there's news that has come out that the president is going to skip part of his trip. I address that here in just a moment. And the market didn't like that, because now they're like, he's having to cancel things to deal with this debt ceiling issue. Maybe there's more problems here than what we're realizing. We were down 0.64% on below average volume. And the technicals, as I said, are mixed. We're still fixated on inflation and interest rates. Kind of at the top right now is this whole debt ceiling issue, and will that get solved? It probably will. It's just going to be an 11th hour type of situation where the market's going to freak out and be all concerned. Then when things finally do get settled, regardless of what the actual agreement is, we may see some kind of a pop higher because of that. Unless things are taken as very negative, then the market may use that as a reason to go down. And then we're wondering, are we going to get any more banking information? So far, it seems like that situation has been under control, but these things can come into the market quickly and really have an impact. What are some comments that we can make? The 4,100 level is still providing pretty significant support. If we break below that, there's also another level at 4,080. There's also a Fibonacci level at 4,020. If we start going down below those levels and see a real pickup in the enthusiasm of selling, that could really suggest that things are going to turn more negative. Also, as I just mentioned, the president will be cutting his trip to the G7 meeting short. He won't go to Australia or Japan, and he will end up returning on Sunday. And again, maybe that has to do with part of the debt ceiling issue. There was no information about the debt ceiling meeting that happened on Tuesday between the president and congressional leaders. However, House Speaker McCarthy came out after the close and said that the two sides are still very far apart. Senate Majority Leader Schumer also said that everyone has agreed that we need to have a bipartisan agreement, and that having a bipartisan bill in both chambers is the only way we can avoid a default. They're digging in their heels pretty strong right now. One side wants the debt ceiling lifted without any restrictions. The other side wants there to be some restrictions, and neither side is really willing to budge right now. Home Depot also put a real drag on the Dow. It declined after its earnings report came out. And then the FTC has filed a lawsuit to block acquisition of Horizon Therapeutics, and this added another tailwind for stocks in Tuesday's session. The dollar was up and interest rates were also up. The 10 to the 5 and the 30 to the 5 remain normal, where the 10 to the 2 and the 10 to the 3 month have now switched back to being inverted. Sentiment, we've ticked down just slightly, and we're in the neutral camp right now at 55, where we had been positive at 59. Our trend, nothing has changed here. It's still positive. The green line's on top, but the green line's coming down. The ADX, it's trying to go across its moving average, but it's still below that, and both of them are below 20. I've kept our bias and momentum at mixed. What are the economic reports that came out? We had retail sales come in, and this is about 40 to 60% of the U.S. economy. They were up 0.4%. They expected them to be up 0.7%, so this is weaker than expected, where last time they came in down 0.7%. If you take out automobiles, we were still up 0.4%, a little bit greater than the 0.3% they had expected. Last time we were down 0.5%. Retail sales were virtually flat when you compare it to inflation. Industrial production came in up 0.5%. They expected it to be unchanged. Last time it was unchanged. Capacity utilization came in at 79.7. They expected it to come in at 79.8. Last time it was at 79.4. Under 80 means a contraction in utilization. So when we're above 80, that means that we're expanding economically. Business inventories were down 0.1%, where they expected it to be unchanged as it was last time. And then the NAHB Housing Market Index came in at 50, better than the 45 they had expected, and last time it also came in at 45. Game of Trades also had another interesting post here. This is looking at the NFIB Business Optimism Index, which I talked about in yesterday's video, and it shows how it's really coming down overall. The current level precedes a recession. So this is in the side that, yes, we are going to go into a recession, where there's other evidence that we're looking at that also suggests that we're not going to go into a recession, and I'm hoping to prepare a supplemental video about that very soon. Game of Trades also put out this other chart that says tech looks overvalued relative to real yields. It says tech valuations are rising without a commensurate decline in real yields. This is a red flag. So it just means that the tech sector is getting a little ahead of itself on a valuation basis. Looking at IsabelNet, this is just showing the economic surprise index, where it has been coming down. As the economic reports are coming out weaker than expected, we can continue to see this fall. This is just showing that a lot of investors at Bank of America are getting more pessimistic on the market. They had been showing an improvement, but now it's starting to trail off. This is the Senior Loan Officer Survey, and it exhibits a strong leading relationship when you compare it to earnings growth. They're both going down overall, suggesting weakness in the economy. Goldman Sachs is still at the lower end of expecting there will be a recession. The median is 66% that we will possibly have a recession. So they tend to be a little bit more optimistic. Then it says as job openings decline, earnings growth should follow. Both job openings are going down and earnings continue to fall. Then you look at the cumulative flows into equities by regions. In the US, that's the dark blue line. It's been trailing off. The Europe line is on the bottom, which is kind of strange because Europe has actually been holding up pretty well. The gray line is emerging markets. This darker blue line on the top is the Asia Pacific arena. Looking at our charts, first looking at the intraday chart, showing how we gapped lower below the daily pivot and we chopped around an awful lot. We came down to S1. We came back up to the daily pivot, then we almost made it back down to S1, and things were pretty much chopping sideways. And then right at the end, this is when the news came out that the president is canceling part of the trip, and so we saw some real selling going into the close. Looking at the SPY, especially in the overnight session, we had been down slightly in the initial overnight session. We saw more weakness in the overnight pre-market session. Then here's the choppiness that occurred during the day, and then the decline that we saw right going into the close. Growth continues to outperform value, but value really got hit in Tuesday's session. And I've taken out the extended hours on this chart. This is an intraday chart showing growth versus value. We're getting weird lines going all over the place, and it wasn't really all that helpful. But this just shows that growth has been holding up better than value. This shows where growth was down, but it was down quite a bit less than value. It was also down less for the mid caps as well as the small caps. Looking at sentiment, our Ulster Index is not really moving all that much, showing that there's a real complacent environment. The VIX ticked up a little bit with that last minute selling that we saw, both on the line chart as well as on the bar chart, but we're still really low overall. And the VIX of the VIX is showing just a little bit of a pickup in volatility. And then looking at the MOVE index on top, this measures volatility of bonds. We're just about at the midpoint where the VIX is very complacent. Then I've also had a spread showing the difference between the two. They're pretty much right on top of each other right now, but their correlation still remains very strong. Then looking at the SPXInvesting index, where the VIX looks at the money options, the SPXInvesting index looks at out of the money options above and below current price. We're just about at the midpoint currently, not getting any kind of an extreme reading. Looking at our one fear gauge, it's starting to go up, and then our other fear gauge is actually ticking down slightly. It's really hard to see, but we've been chopping more or less sideways. Folks are still favoring a risk-off position, even though it's bouncing back up slightly. Looking at our advanced decline line studies, we had a pretty significant down day based on price, and most of that came right at the close, where we declined based on price, we're declining based on volume. As I've been pointing out, in the short term, we're seeing a negative divergence where price is above its moving average, volume is below. Longer term, we're also seeing a negative divergence where price was making a series of higher lows and volume was making a series of lower lows. The new highs, new lows, this is also suggesting internal weakness. We continue to fall off with our 5-period and 10-period moving average. The advanced decline ratio has dropped a little bit below zero. Accumulation distribution, even though it ticked down, is still positive overall. And then we're still seeing negative divergences when we look at the NYSE cumulative advanced decline line as well as the regular advanced decline line. And here is the advanced decline line with the S&P on top. I'm probably going to extend this trend line here. If we come down and break this, that could be fairly significant. Looking at common stock, we're also continuing to see negative divergences. Looking at our broad measure with the NYSE, it did decline. The S&P declined, but it's still above its moving average. Mid caps declined, and small caps as a whole continue to show weakness. Looking at our trend, nothing has changed here. The ADX is trying to go above the moving average, but it's not quite there yet. The green line is on top, but it is declining overall. So we're in a sideways market environment with a default to the positive since the green line's on top. Volume continues to drop off. On a short-term basis, we're just chopping sideways in our daily chart, and you can see at the bottom where volume continues to go down. We're now down at the lower end of our 20-period moving average study. We had been slightly above the simple moving average yesterday. Now we've dropped down below the exponential moving average after today's session. Our stochastics dropping a little bit below 50 in the short term, turning down in the intermediate term, and the long-term stochastic continues to decline. The force index has dropped slightly below zero. That is somewhat negative. Some intermediate term charts. The balance of power is still below the dashed line. That's negative, but showing some improvement. And we're just a little bit below both the double and triple exponential moving averages. The go, no-go system is chopping sideways with darker blue bars. That's still positive. And we're watching this 40.77 level. If we start to fall in the S&P, that could be another significant support level, which kind of equates to that 40.80 level that I'd already mentioned. The TTM squeeze looking a little bit better, but it's still negative. The PPO studies were still positive in the long and intermediate term, even though we're showing some weakness, and we've dropped slightly below zero in the short term. Our Arun indicator has not changed, and it still remains negative. McClellan oscillator on the S&P 500 is showing more weakness and a longer-term negative divergence. The same thing is true with the NYSE McClellan oscillator. The Swinland trading oscillator has declined based on price as well as volume. We're also working off this longer-term negative divergence. The Elder Impulse system for the S&P has turned to negative with a red bar. The PMO study also showing this longer-term negative divergence. We declined with the PMOs that are rising. We also declined with the buy signals, and we ticked down slightly with the PMOs that are above zero. The parabolic SAR remains negative. Our PMO study is also looking more negative overall and declining based on price and volume. We're watching the slope indicator. It's trying to go above its moving average, but it hasn't quite crossed that yet, and all of our other oscillators remain negative. We're now dropping below the 20-period moving averages in the moving average tree, and the BPI is still just a little bit above 50. That's just slightly positive. And the NYSE bullish percent index is chopping sideways and below 50, so that's negative. And now here's a new chart based on the final bar video that I watched after the market closed, where we're going sideways with the S&P BPI, but we're seeing some strength in the NASDAQ 100 BPI. And this is the area of the market that's been holding up the best. The Chaikin money flow is declining a bit, but is still positive. The Chaikin oscillator has also turned down, but is still positive. The money flow index is just a little bit above 50, so that's slightly positive. The ultimate oscillator has turned down, but it's still above 50. That's positive. The vortex still is showing that the green line is going up. That's positive. On-balance volume is below a declining moving average. That's negative. The summation index based on price is declining as well as volume, and we're below zero and also working off of a negative divergence. And then this chart just shows the percent of stocks above their 200-day moving average. We're seeing some weakness here in the S&P. We're also seeing weakness when we look at their 50-period moving average. Some Fibonacci and line studies, we're still below this 4170 level. We're about 62 points away currently. And we drop down below this 4123 level to close at 4109. Longer term, if we do start to go up, we're looking at resistance at 4156. That's about 45 points away from current price. And if we do start to fall, we will be looking at the 4020 level. We're also right in the middle of our 20-period simple moving average of the high, low, open, and close. And we're also wondering if we do start to go up, will we hit resistance at about 4200 when we look at the upper side of this downward sloping trend channel? The 50-day cycle, we're coming to an end on Friday. Is that going to have an impact on the market? We're also looking at this blue line, which is 4080. Looking at our different charts, the Heikin Ashi is a little more negative now. The Kegi is also negative, pointing down with the red line. And the Renko has redrawn to look more negative. The 3-line break, though, is still looking positive. Looking at our different indexes, the equal weight index continues to underperform the S&P. Looking at new Dow theory, we're still above this blue line with the S&P. We're also above this blue line in the NASDAQ. Can that continue? The transports continue to underperform the Dow. The Dow also broke below its 50-period moving average, but we're still above this S2 support level. The diamonds have switched to negative. The NASDAQ is still above this breakout line here, but we're running into resistance at this R1 level. The NASDAQ, if it does continue to go up, we may hit resistance at this 38.2% retracement level. The NASDAQ 100 actually broke above the R1 level, so that's more positive. And this has been the leader lately in the market. And the Qs have remained positive for the Elder Impulse system. And we're coming up to this 50% retracement now. We're about 200 points away or so at the 13,614 level. The small caps as a whole index continue to show weakness. The Russell has dropped below the RSI on the top, and the MACD is pretty much treading sideways. The small caps continue to underperform the S&P. And here's another chart that was new yesterday put out by Shivako Capital, where the S&P has been showing some strength, but when you look at the new highs minus the new lows and make a cumulative calculation of that, we're seeing a real strong negative divergence. The small caps have switched back to negative. And here's looking at small cap growth versus value, where we have been seeing some overall strength lately, even though the index itself has been coming down. And this could be the smart money going in and buying small cap stocks. The index is not reflecting any kind of strength here, but we're seeing this under the surface. The mid caps are also in a downtrend when looking at the index, and they've dropped below the S1 level. The micro caps were down, but we're still above 100. The mid caps have switched over to negative for the Elder's Impulse system. And here's another look where the mid-caps have been going down overall, but we're seeing strength in the mid-caps, and they were even up in Tuesday's session. But we're seeing some strength when we take the mid-cap growth compared to the mid-cap value. So again, this could be the smart money going in and doing this. Maybe they're buying into weakness and selling into strength. Looking at the home builders where the S&P has been going sideways, we ticked down a little bit with the ETF. The ratio is still holding up fairly well. And they're having a fairly strong tendency to go in the same overall direction. But lately, home builders have been doing better than the S&P. Giving a quick look at the financial sector where we were down almost 1%. And the financials are continuing to underperform the S&P, and the regional banking ETF actually bounced up a little bit when compared to the financial sector. Our interest rate studies and analysis, we're not seeing any change. We're still inside of the rainbow here. And this is the chart that I used as the basis for the supplemental video. And I have a lot of other charts that you can see in that video. Looking at bonds, there's still a pretty solid distance between the S&P and the long-term bond ETF. Longer term, their relationship tends to go in the same direction. But shorter term, we're seeing them tending to go in opposite directions. Bond yields were up and bond prices were down, and we came down to this 50-period moving average here. Will that provide some kind of support? I talk about the yield curve in every day's video, but I don't always show a chart. On the top, this is the 10 to the 2-year yield. When we're below this red line, that means we're inverted. We're also looking at the 10 to the 3-month, which remains inverted and very inverted. It keeps going down. Where the 30 to the 5 and the 10 to the 5 have now crossed back above this zero line. I typically don't use this chart on the bottom very often because this is the Fed funds rate, and that's only updated once a month. So what I do is I look at a chart of a thing called the euro dollar, which are dollars outside of the US in other banks. Our long-term analysis, we're coming back down from the red line with the special K. So far, it has rejected the opportunity to turn over to a positive trend. Then our other long-term analysis shows the MACD is rolling over a little bit, but we're still above zero, still suggesting that this breakout above the trend line is legitimate, at least for now. An update of some possible positive scenario charts. The Qs really outperformed the S&P. Discretionary is running into some trouble, and large cap growth is outperforming large cap value. And then our growth to value ratios also showing pretty much across the board strength. The S&P continues to underperform the utilities. When we look at our broad range of the highs minus the lows, we continue to be negative overall. And our 50-period new highs minus the new lows, we're turning down slightly, but we're still above zero. When we look at the indicator, we're dropping down a little bit, but we're just barely positive at this time. The 2-year yield has been coming down a little bit, even though it went up in Tuesday's session. We're wondering if this spike, and then as this falls, will that give some support to stocks? We're also looking at our staples against the S&P 500 ratio. We're wondering if these two spikes are enough. We came down a little bit, but now we're starting to go back up. So what's our outlook for Wednesday? We're still dealing with earnings season. A lot of the retail companies will be coming out this week. The technicals remain mixed. The economic reports that are coming out, we'll get the MBA mortgage index, housing starts, and building permits. And sometimes these can be leading indicators since you have to do all these things before you start building. And then the whole list of geopolitical events. It seems to be coming to the surface now about this whole debt ceiling. And then here's the schedule of the Fed officials making speeches. There are none on Wednesday. The next speech will be on Thursday, where Governor Jefferson will talk, but then the more important one will likely be Vice Chair Barr, who will then be testifying before the Senate Committee on Banking, Housing, and Urban Affairs. And then we're keeping an eye open for this meeting between Chairperson Powell and former Chairperson Bernanke, and they'll get together and talk on Friday. The Stock Traders Almanac statistics for Wednesday, May 17th, were pretty much negative across the board with the Dow and the S&P, a little bit more neutral to negative with the NASDAQ, and then we tend to be more positive in the month of May. But looking at those charts, we tend to see more weakness as we're entering the latter part of May. We're on the 13th trading day of the month, showing that overall during a pre-election year, the green line is going down slightly. Our scenarios, again, I'm not really saying anything new here, but we still want to look at these things every day. It's hard to really go with the down scenario unless you want to take advantage of the negative divergences, but we're not getting a lot of confirmation that we're really in a downtrend yet. We can't really go with the uptrend right now because of those negative divergences, and we're just chopping more or less sideways. So we continue to be in a sideways to neutral trend because the ADX is weakening. It's below its moving average, even though it's trying to turn back up, but both of them are still below 20. We are positive with the green line on top, but it is declining. So our warning signs, there are numerous negative divergences that are all coming together now. The VIX is showing a lot of complacency. The S&P is underperforming utilities. We're still in a risk-off posture. Small caps are underperforming when you look at the whole index, and the mid caps have generated a recent death cross, which is also negative for the index. Earnings season continues. It was negative on Tuesday when Home Depot came out. I think it's Target that will be the big company coming out on Wednesday. And then some positive signs, longer term positive seasonality and setups, those are still there and they apply to the whole year. We may find some support levels if we start to drop. The NASDAQ may be breaking out above resistance. Small and mid cap growth is showing some strength when relative to the rest of the market, especially their own indexes. Is the market bottoming by consolidating sideways? Not really a lot of evidence for that right now, but just something to keep in the back of our mind. Our conclusion, and nothing has changed here. The S&P is mixed, it's not trending, and it's showing a lot of negative divergences. In the short term and intermediate term, we're mixed. We're still positive in the long term because we're above the 200-day simple moving average. So thank you. I hope you found this video helpful, and I will talk to you in the next video.